Hey everybody, this is Jose Blasco. We are about to get started. We are just a few seconds to go. A quick sound check as always. That way we can confirm that all is good to get started on time. All should be good, but again, it's always very appreciated to get your confirmation. So please type a quick hello on the chat box so I know. In the meantime, I'll put myself in the bottom right corner so we are ready to get started this way. And we are just 15 seconds to go as we start the session. Thank you so much. Thank you, Christian. Thank you, Lilan. Thank you, Maka. Everybody on the other streams as well. Wonderful. Okay, great. Everybody, we are live. The session has just started. Please read the disclaimer carefully on the upper left side of the screen. This is, as I always say, important information. So again, do not rush it. Read it completely. It is indeed important. Welcome to Options with Options. Today is July 29, 2021. My name is Jose Blasco. I will be leading the session as always on the Thursdays where we're doing our options trading Wednesdays and Thursdays. Today it's Thursday. So we're going to be looking at the markets and finding those opportunities and getting ready to execute them as long as they meet our rules. Agenda, we're going to look at the market, review the trades, talk about trade management for potential possible open positions that we may have. And from there, we'll look into new opportunities, plan them, and execute them. Okay, that's the plan. How are you, Wayne? Good to see you, my friend. Good to see everybody. Very nice. Cool. So let's begin, everybody. So let's begin doing a little bit of market analysis. Okay, so we'll start with the S&P. Again, what I have here on the left, it's a daily time frame of the S&P 500 index. Is the ETF SPY that I'm using. As we expected from the prior days, and as it's been happening for 6 candles now, we have a confirmed climate to the upside. Statistics suggest that the duration is likely going to be 9. This is candle number 6. So things are behaving, or things are happening according to plan. We are now, just a few minutes ago, started making all-time high. So that implies, 3 more days, implies that we may have a strong push. And also, as I commented before, we have UFOs here closer to price. It's not like we have open space like all of this. We actually have UFOs relatively close to price. So if the market was to kind of have a little bit of a tease with, breaking to all-time high and then come back down, then from here we may see a price coming back up, especially given the fact that 437 is actually lining up with those beautiful UFOs right there at 437, isn't it? So again, this is what we have. That UFO has proven to work pretty nicely, with that little keys there, with that bottom wick, and from there price rocketed up. So it seems that we may get a bit more of that. Now, when looking at options prices, you can see the same fight that we talked about yesterday, where implied volatility for calls and puts is exactly the same, 12.00. So you can see how there is a big fight. Many people buying calls, many people buying puts, more or less the same quantity. At least this is how it reflects when it comes to the implied volatility. So looking at what's happening in the options place, if you wish, thanks to the options volume map. So we can see 1.8 times more calls than puts traded, and it's above average for the calls. 1.5 times more calls traded, and it's above average. 3.1 times more calls traded, and is very much above average. And 1.9 calls traded more than puts, and also above average. So behind the scenes, indeed, it looks like there is a lot of willingness, of buyers out there, getting into positions which imply bullish sentiment. Okay, I got the word, it was not coming. Anyway, Joanne, how are you? Good to see you. Siderman, good to see you as well. Mario, it's very nice to see you all here. Very nice, very good. Okay, so let's continue understanding what we got in our hands. Okay, so when we look at the VIX, okay, I'm looking at the S&P 500 volatility index in this case, and we can see how volatility keeps going lower. We can see red UFO showing up here. So that was not present yesterday, but it is today, and that gives much more of a supporting tool to the fact that the market is going to continue moving higher, because if the S&P tries to fall, the price of the options are either going to come to this UFO or that one, and therefore bounce down. And if implied volatility keeps going lower, typically the markets are going higher. So from different angles, so far, we can indeed say that what we got in front of us is relatively bullish. Okay, so I'm going to move into TradeStation now that we know a bit more about the market, and we're going to look at the one position that we have here to be reviewed, which is SKT. Okay, now with SKT, you can see the earnings is on August 3, so it's really truly around the corner. And that may save the trade, because at this moment in time, as we discussed yesterday and in prior sessions, so we expected the market to go higher from this point, and it's only gone completely opposite to what we thought. Good news is that we converted this original calendar into a vertical spread by selling the 21 call against the 20 call. We're using August expiration, so we got basically time until was it August 20, I believe. Let me see. Yes, August 20 for whatever needs to happen. Okay, we got that amount of time. And the good news is that on August 3, earnings will be reported. We don't know what's going to happen, of course, but one potential opportunity there, which is a potential benefit for the trade, is that we may have a very strong jump up on the price of the stock because of earnings, whatever they are. And next thing you know, this trade is now back into profit. That may be the case. And if not, worst case, as we saw yesterday, this trade has a maximum risk of $57, if I remember well. So not a big deal if in the end it doesn't work well, okay? I don't have this trade on the TOS account. Okay, I don't have it because I didn't get filled on that day. I know some of you did do the trade the day after I planned the trade, and I know some of you have it, but I don't. So the most I can do really here is to basically SKT. So bring it here. So we can see the parameters I just mentioned. And from there, we're going to start planning new trades immediately. Okay, so today we should be able to spend more time with the planning. Okay, so 67 minus 10 is $57 of risk that this trade has as the worst case scenario. And if you got a big jump on earnings, so the most this trade will make is 43, which is not a big deal. But again, it would be very well welcome, especially given the fact that we were wrong on this trade. The market moved against us, and switching to defensive mode, it's indeed giving that trade second chance while the risk has been reduced. Okay, so this is where we are at. Ahmed, how are you? It's good to see you. Very good to see you, everybody. Very nice. Perfect. Okay, so hey, let's look for new trades. Okay, let's look for new trades. And in the past sessions, as you know, we've been spending some time with our new little, is it fair for me to call it new little toy? Not sure if that's a proper way to say it. But anyway, it puts a smile on my face when I use it. So I guess it's okay to call it a toy. So we've been looking into some of the functionalities one step at a time. And every time that we've been looking into some functionalities, I have been discussing the reason why we're using certain functionality, which basically has been a combination of lecture time and time on the platform. And because of that, we didn't have too many trades executed in the recent couple of weeks. But I believe that today, being 08, we still have 52 minutes to go, and we should be able to do much more today. Okay, so let's begin. Okay, so let me float our matrix. I will not repeat what I explained yesterday. Okay, I will just restart from where we left yesterday, which was we were looking for stocks that provide a positive CIV spread on their options prices. We are looking for stocks that are $34 minimum with 300K of volume for the underlying asset. We are looking for stocks where both the stock and its group are both in strong up trend strength. Okay, this is not only trend, but it's also strength. We also loaded a list, okay, which I told you is the penny increment stock list. Okay, making money is fun. Very good, Joe. Little aha, got it. So this list is the penny increment options list that I offered to email you if you guys email me. You can also get it from TOS, but I have it ready in a file if you want to. And also, we were filtering for stocks that got earnings beyond 5 days. So at least, if we get into a trade today, at least we don't have any surprise coming from earnings in 5 days, meaning that at least the stock could peacefully start traveling towards the target, and we got 5 days to decide or act on trade management. If earnings were going to happen in 1 or 2 days from now, so then basically you have no time for price movement, okay, because you need to be out before earnings. So so this is the type of filtering that we had done, okay, yesterday. And when we click scan, this is the list of stocks that we have available now real time, okay? Now, of course, in a more perfectionist fashion, we also looked into looking at continuous implied volatility for the puts to be below the 20 percentile, okay? And when we do that, the list normally it's shortened, okay? So, but again, it's always the right place where to start, because if you recall from yesterday, Mario, the strong trend, if that's okay, we'll talk about that, because all of those are other tools that I'll need to discuss for the chart. The point is that those tools are not only looking at direction, they're also looking at likely probability for the direction to continue, okay, which is basically what strength means, okay? But we'll talk more about how it's done behind the scenes. Also, remember, we will also add auto climate to the filtering, which I don't have it yet, okay, at this moment in time on the screen, okay, but we have it. So anyway, we have the list of stocks, okay, and we're gonna start looking at those stocks and see if our charts are gonna validate the trade for us to take it or not. Also, remember something I said, which is, it's okay if you end up with very few opportunities or none. There is always an opportunity to end up with, without looking at options to be cheap, okay, we'll be able to get a longer list of stocks, and then we can always run on those stocks directional butterflies, which is something I need to explain, which are going to be option strategies that pay you well when the stock moves in a specific direction, but also manage very well the changes of implied volatility of the options, which are likely going to happen and may happen against the trader if the options are not cheap. Because when options are very cheap or underpriced, what's more likely to happen is that they will gain value, right? So then you want to have exposure to the changes of implied volatility. But if the options are not that cheap, so then you really don't know what's going to happen, and then we prefer to neutralize the exposure to changes of implied volatility, which we will do with directional butterflies, which is something that I will need to teach because I have never addressed it in the sessions, okay? But so far, when I also filter for cheap options, which remember, we have two ways to do it, with puts less than 20 percentile or CAV mean minus historic, not above, below 2 standard deviations, okay? Those are two different ways to look at cheap options, okay? One is purely based on the price of the option. The second method is looking at the price of the options compared to what is the underlying capable of doing, okay? So it's both are valid ways on how to represent options prices, okay? So we start with the first one, because of course it's a better advantage to start with a cheap trade. Obviously, the lower the cost, the lower the risk. So let's go for it. We have Marvel. So let's begin with looking at Marvel, and let's see what's going to happen. I want to move this to my other computer screen. We don't need it right now, and I will bring it up later on. So now with Marvel, if I look at my classical setup that has been for a long time, and by the way, it's very absolutely 100% valid, which is daily time frame combined with the 55-minute time frame. Okay, so we got a climate which is 7 out of 6. Okay, and that would not work. So again, what I want to look at here, I like to start with 4 days. Okay, this is something that you could not do with the majority of platforms out there in the market. You could chart for multiple minute charts and even customize your time frame. Like on TradeStation, you can type 240 minutes, for example, and have a minute chart with customized time frames. But you cannot do it with days. You can only do it with minutes. In this case, we are doing it with days, and as I explained yesterday, I won't repeat it today, it's giving us an edge when it comes to UFO stats, because, like, for example, Marvel got an incredible 58%, which is quite significant for a stock. But when you move to the daily time frame, notice how this drops to 45%, which is quite deceiving, isn't it? It's quite deceiving. So, and again, we talked about why that happens. The US market is open 6.5 hours a day, meaning that it's closed for longer than what it's open. So there are many orders that are being canceled. But when you look at those UFOs and those markets, those charts, from a 2-day, 3-day perspective, so then you end up picking or identifying pockets of unfilled orders that didn't expire for more than a day, and those become so much more relevant. And when you actually backtest it and throw stats, notice that now we got 54% instead of 40 something, which makes it much more relevant. So again, I'm gonna give priority to combining things like 4 days with 2 days instead of combining 1 day with 55 minutes, which is absolutely right. It's absolutely not wrong. It's absolutely right, because notice again, when you drop to 55-minute time frames, now you get very good performance stats as well, because those intraday orders, typically they get canceled less often. Okay, so and it's not because I say, it's just because statistics show that. Okay, so it's not about what I say, it's about what it is. Okay, so anyway, if I look at the 4-day chart for Marvel, unfortunately, from a climate point of view, we are hitting 12 out of 7. So that market, it's too extended. So I can check the 3-day to see. And with the 3-day, guess what? I found a different scenario that does give me permission for me to look into trading it. But unfortunately, in this case, we can see that as an average, the puts are still surpassing the calls. And therefore, I don't have the benefit coming from the options prices, okay, as an average, okay, overall. But again, nothing wrong, and to be honest, is even more precise than this, to look at the volume map. And if the volume map is giving us a reason, so then we can go ahead and do something about it, right? And the volume map is actually kind of creating a little bit of contradictions here. And in a situation like that, I would not really trust it too much, because you can see 2.5 more calls and puts and above the average. That looks good. But then on the second one, it says 62 times more calls and puts, which you would say like, oh my God, that's amazing, it's going to the moon. Yeah, but that's because only 5 puts have been traded. In other words, when certain markets are not so liquid, then I will give more importance to this analysis on the left. And when some markets have much more volume traded, so then the volume map becomes extremely useful, but not in this case, okay? Not in this case, because this is not representative. Plus, you see more calls than puts, but now you see more puts than calls, and therefore it's not telling you anything. So in cases like this, basically, I would pass, okay, because we don't have that average improvement on the implied volatility for the calls. You have it for today, okay? You have it for today. So if instead of 3-day average, I charted for today, the fact that it's there on the list, it means today is like that. But it's not happening as an average. And because we are trying to get into a market that is moving in a direction and is going to last or potentially last, so we want it to be as an average. So next one in the list is Pfizer, okay? So let's take a look at what's going on with Pfizer. So with Pfizer, okay, let's begin with the 4-day, okay? So with the 4-day, we got 6 out of 6, okay? So it's okay for us to get in, okay? It's okay for us to get in, but puts are clearly greater than calls, okay? The difference is humongous, okay? Humongous, and we are not surpassing the average call volume, okay? We are actually very shy. I mean, more calls than puts, but very shy under the average, okay? So we don't see anything from behind the scenes from the options arena. We don't see anything that suggests that stock is going to continue, and actually, with more puts than call kicking in and getting closer to the end of the climate, probably the opposite is going to be true. So, or maybe not, but the moves you're going to get are not going to be significant to get to very far away targets. So we're going to move to BMI, which is the next one in the list, okay, and see what's going to happen here, which is a climate of 8 out of 6, okay? So we're not going to take this one. Before I give up on this, let me look at the 3-day time frame as well, which is 7 out of 8. So again, 7 out of 8 would give me permission, okay, with Bristol Myers, but we got more puts than calls as an average, okay? So let's take a look at the daily map to see what the daily map has to say. And the daily map, it's not giving us any positive indication for the upper side, because here we got more puts than calls, here is more calls than puts. But the worst part is that nothing is surpassing the averages, which is that little triangle. That's the average of call volume. So in other words, we don't see a clear continuation for those particular stocks. And therefore, we're going to go for the next one, which is VeriSign. So let's take a look at VeriSign. VeriSign on a 4-day, it's on a red climate. On a 3-day, is on a red climate. On a 2-day, is on a red climate. So no matter what, is in a red climate. And therefore, I'm not going to check a day. I mean, it's clear it's in a red climate too. So I'm not going to get into this one, okay? So let's look at Sienna Corporation. So let's see what we've got. So on the 4-day, we are in an up climate, okay? We are. It seems that we got more puts than calls, okay? So let's take a look at Sienna options volume to see if we get some confirmation. Okay, some confirmation, and in this case, I'm going to take it as a valid one. Again, the first indication, 21 more calls than puts. I'm not going to give it too much importance because it's only 5 puts, just like here, 6 times, it's only 2 puts. Okay, but here we got a greater indication. Okay, and we are getting very close to surpassing the average for the call volume. So certainly, it seems that it's kicking in. Some call buying, it's entering the market. And again, given the fact that this particular stock is not super liquid, so definitely this may work well. Okay, so let's look into that. Okay, let's look into that. We're going to move into a 2-day chart on the right. Let me go ahead and do some deletes. Got some writing, some other trades that I have taken here before. Okay, so remove lines, the current symbol. Here we go. So what do we have? We got more than 50% on the 2-day chart. The average is pointing at 56.39, which is indeed inside that UFO. So my friends, we have a trade in front of us, okay, which could be planned. Again, we have more puts than calls there, okay? More implied volatility for puts than calls. That's not ideal. But again, by looking at the volume map, we saw call buying is kicking in, okay? So we can certainly rely on that, especially all the other odds that we have stacked in our favor, such as the grouping of the stock is in our favor, the stock itself is in our favor, the auto climate, most importantly, is in our favor. All of these things, we have the UFO lining up, and we have everything that basically we need, okay? So good. So let's go for it. Okay, let's plan on this trade. Let me take a look at the 3-day out of curiosity as well. So the 3-day is also providing 55. The UFO is 53. That UFO is lower. Okay, so we're gonna go for the 2-day. The 2-day provides a UFO in the very perfect location for us to take this trade. Okay, so yeah, so let's go for it. This is the trade that we're going to plan now. And also, when it comes to taking this trade, I'm going to give you 2 choices on how to go ahead and get into this trade. One, which is the recommended way on how to do it, is to wait for the stock to retraces and from 57.90 to drop $1 to 56.97. Okay, and now you get in, and now you expect it to bounce. This is one way to do it. Okay, and the other way to approach this, would be to find a way to do it now. Okay, it's never going to be exactly now, but as close to now as possible. Because what if you need this trade for hedging purposes? Okay, so what if you already have multiple positions in your account where you're short, but now the market is going to take off and make all-time high, and you have nothing to protect yourself against those shorts. So, and you need a long trade for hedging purposes. So, starting from now on, I will give you 2 choices on how to enter, which is entering by waiting for price to come into this UFO, and also entering, now, right now. Okay, so to enter by waiting for price to come to the UFO, then you have to wait, right? And when it comes here, that's your triggering condition for the timing, for the right timing for the trade, for you to buy whatever option strategy we're going to put together, and then ride the move if right, or suffer some losses if it moves against you. The other way on how to address an entry, okay, is going to be to drop to the 8-minute time frame. Okay, I believe I mentioned this yesterday, I think so. And we're going to add a pivot tool, which is going to show us pivot highs and pivot lows. In this case, we have a little purple indication there, which means that that's an official pivot high that we can use as like a triggering condition to enter. So that high is 58. Sorry for that. I just hit the wrong keyboard combination. That high is 58.13. So if Sienna Corporation was to rally and surpass 58.13, you can get in, okay? And yes, that would be a breakout trade, but you need it because it's a hedge, and precisely because it's a breakout trade and the S&P is doing a breakout for all times high. So that just may go and go and go, right? And it's kind of like, what if you did a breakout trade of this high on that candle? So notice what just happened afterwards, right? So you don't want to miss that if you need to hedge. Okay, that move is going to happen against your short positions. You don't want to miss that. So that's why taking this trade above this high would be allowed. I would never do it if I got nothing in my account and I want to go long. If that's the case, I would just wait patiently for price to retrace into the UFO we said. But what if you got all those shorts? Okay, so I want to make sure I make this clear for everybody, because this is something that I have not addressed in the sessions before. And my concern as your coach here is that I get you all confused and it's like, Jose, what did you just say? You're going to take a breakout trade? I never seen you do that. Okay, well, yeah, you never seen me do that. But again, we are getting more and more advanced. And in this case, I'm talking about portfolio management, which is running multiple positions at the same time. Please give me a little bit of feedback, so I know you are with me and you understand what I just said and I'm not getting you confused. So this is action number one. Action number two will also be to add a Elliott wave turning point tool. Okay. So now, if at any moment in time we have any turning point, we're going to be indicated like the last one took place here. When that turning point took place, that candle indicated a potential turning point. So far, we didn't have any more, but this diamond is a turning point. That gray little circle is a turning point. That's another one. Those yellow, orange in this case are pointing to the downside. We don't care about the downside because the climate is up, the grouping of the stock is up. So we don't care. We're going to ignore the ones pointing down. But if at any moment in time, let's say in this candle or 8 minutes, 20 minutes later, whatever, we got an indication here, then we're going to take the trade using the next candle as long as, we got a price trades above the prior candle high, okay? So again, that way, because again, this pivot high is very high, and the question is, what if you need to hedge, but this keeps going down? Well, if this keeps going down, it's not an issue because you are getting closer to a better entry. And if you have a portfolio full of shorts, all those shorts are supposed to be doing better because typically stocks move in tandem. Not all of them, but typically yes. So if it keeps dropping and you're getting further away from that pivot high, patience pay. Okay, it's not time to hedge. You can just wait. Okay, but now if it goes down, 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 and even though let's say it hasn't got to our UFO, I'm reading you, Siderman. Thanks for that, Mario, Lilan. Nice, thank you for that. So if this keeps going down, 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 and let's say it hasn't reached our green UFO from the 2-day time frame, this is the 8-minute time frame. Okay, don't get confused. So if we're traveling towards the UFO on the 2-day time frame, but we haven't got there yet, and next thing you know, it starts turning in a way where based on the Elliott wave, this is an Elliott wave turning point, or potentially it is. Okay, so what we're gonna do is that we're gonna wait for whatever candle shape we have here. Let me try to be a bit creative here with the use of my drawing tools and draw something that resembles a candle. Okay, so let's say we have some sort of a candle like that, and then we have one of those indications like that triangle, for example. So what we're going to do is that the moment next candle trades above the prior candle high, right there is going to be your indication to enter for your hedge. Okay, so basically, when it comes to directional trading, we're going to be able, look at that, it just happened. We just got an Elliott wave indication. Okay, and this would be the indication for us to get in. Okay, so unfortunately, I haven't planned the trade yet. Okay, but if we were planning this trade right now, we would be executing the trade together. Okay, because we got the Elliott wave turning point and we are trading above the prior candle high. Okay, so that's exactly what we were doing. Okay, so anyway, so let's work on this. Okay, so we are planning on this trade, even though we are entering based on the intraday time frame, little trick technique on how to be tricky with the timing. Okay, which is never the ideal way, but sometimes you need for hedging purposes. One more time. So if you were to do that, the next question is, where are you going to set your target? Okay, so yesterday I was pointing at the 4-day time frame, which is the time frame where we have our auto climate, and I remember looking for the prior purple area and clicking on our speed bump tool that basically showed where a target could be as the climate propagates. Okay, so in a perfect world, if that climate keeps propagating, it may go all the way to around 63, 64, something like that. But again, when it comes to taking profits for the trade, I like to be a bit more conservative. So even though I'm looking at the climate as a 4-day, I'm going to plan my target using the 2-day, which depending on where the high is, okay, is going to give me targets in a very similar location. Okay, so in this case, you can see let me see, I may not have clicked in the right place. I feel the target is just too close. Right there, exactly. I was feeling like that's a little too far, a little too close. So this is where the target would be, which is pointing at 63.95. So in this case, notice how looking at the 2-day and looking at the 4-day kind of coincides pretty nicely. 62.95 is like the bottom part of here, where in this case, yeah, it's about the same, more or less about the same. So the beauty of this tool with the speed bumps is that it does not depend on the time frame that you use. Okay, no matter if I was to use a 5-minute time frame, it will give me the same target. What it depends on is which pivot high are you using. Okay, and because I'm using that pivot high and I'm using that pivot high, which are the same, okay, it's the same date, same pivot high, so then the projection of the target is basically the same. Okay, so this is a nice one. It will not always be the same, okay, but in this case it is. Okay, great. So this is going to be our target. Okay, and we got the Elliott wave turning point in the intraday time frame. Let's pretend you need to get into the trade. So now it's time for us to put a trade together. If we were to do it with TradeStation, okay, I'm just going to compare a little bit. So I believe that if I compare with TradeStation or without TradeStation, it's going to help you to kind of compare the steps that we take, which are going to be the same but with different technology. Okay, so with TradeStation, what I would have done is basically load the option chain. Okay, load the option chain and basically look at, okay, so I said my target is going to be around 63. The current price of that stock is $57.99. So we are talking about we need $5. $5 is provided by that expiration date, 6/80, which is 3 of September. And then you would come to TradeStation and you would say, expiration dates are in September, so great, it's just perfect. If not, you would have moved to September because you want to be lining up with the expiration date that is more or less in line with earnings, isn't it? So you would have done that. But the other thing that we're going to do with top is to try to be a bit more precise with the expiration dates because it's going to help, as you will see. So there will be different ways on how to do this, okay? But one of the ways to do this will be to use the strategy builder. And I'm just going to hit the target because this is basically going to project what the target date should be. The way on how this target date is calculated, 9:05, is way more complex than what we are doing with TradeStation here, which in this case kind of coincides. September 3 expiration, it provides $6.6 of movement. the other tool gave us September 5. So in this case, it kind of coincides. There will be other cases where there are significant differences. So basically, the way on how top is going to calculate target has a lot to do with, look, if I look at the daily time frame, I got another tool here, which looks like cones, which is projecting price movement through time. And all these dotted lines that you see vertically speaking are the various expiration dates that are upcoming. Okay. So if you were to look at all of that, and you were to think of where the target is, which is the pink zone here, and you were to draw some sort of a regression line, okay, so basically that regression line will intersect with the target on a specific date in the future, okay, and basically what we're doing is we are looking at all sorts of things. We're looking at expiration dates, we are looking at speed of movement based on blue lines, historic volatility, and red line, implied volatility. And on top of that, we're also looking at a regression line that may show you where price should go as a statistical average into the future if price behaves the way it's behaved in the past, which is another way to think of historic volatility. So we're kind of projecting price movement into the future, trying to be as precise as possible to find out in which date we would reach that specific target. Of course, we're never going to know for sure because that would imply to have a crystal ball, which we don't have. But this is going to give you a very precise and optimal way on how to find out where your target should be. Okay? And here, exactly. So I must have clicked there by mistake. So, so in other words, we are doing all of this behind the scenes. Ultimately, 905 is the date we need to keep in mind. And with 905 and the earnings date coming in September, so you will want to use September 3 expiration to do this trade. Okay. Now, of course, when I look at this carefully, you may also notice, a pretty bad slippage there on this expiration date. So this may open the door for me to look at the next expiration date, which is even worse slippage. So probably the best choice to do this trade would be to use the monthly expiration date that expire in September, which is probably providing the healthiest, options prices in order to avoid slippage and be able to negotiate your spreads the best as possible. So what I would have done now with TradeStation, what I'm going to do is to analyze and buy a single call, to also analyze and buy a vertical spread, which is going to be a bull call spread, to also come in here and analyze and buy a diagonal spread. Okay, and I would not do a directional butterfly because remember when we looked at the matrix using top, so we are filtering for CIV put less than 20, meaning that those options are cheap for Sienna Corporation. So no need to utilize 3 options per trade. I could go ahead and use either one option, which is my call, or use a basic spread such as a vertical spread or a diagonal spread, which is two options at a time instead of 3. So I save myself slippage, I save myself commissions. Okay, so no need to do the directional butterfly in this case. And then here you would just put the trade together. Okay, but let's do this. I'm gonna work a bit more on top. Okay, even though there are certain tools that I have on another version of top, which is still in beta stage and will be released very, very soon. But basically, I'm going to show you, something a little more basic than what we'll have in just a few days, which is the spread builder, where with the spread builder, I'm going to select September 17 as the expiration date I want to use. Okay, I'm going to select September 5 as the target date that is supposed to be. And I'm going to select long call, bull call spread, bull call diagonal spread as the 3 types of strategies that we want to plan and simulate and play with. Okay. Now, the current price of that stock is 57.98. The strikes available are 55 or 60. Okay, I don't have 57.5. Okay, and using the right optimal option strike to begin the trade, is key. So in this sense, my friends, be ready, because I'm going to teach you another new technique on how to make your options trading even more advanced. I apologize if I'm driving you crazy, guys. I will repeat everything a million times so it sticks. It's little by little is embedded in what you do. You will see, Joe, you are just reading my mind. We will have default data, so we have filters here where we're gonna be setting certain deltas and things and all sorts of things that will make our trades better. Okay, it's all there. But before, I want to be visual. Okay, I want to be visual. So I'm going to come back to the spread select tool in just a moment. I'm going to go back to a basic risk graph tool. Okay, so I can demonstrate something which is very important for you to understand, which is, again, something absolutely new. Okay, it's something that we never talked about, and it's very, very powerful, guys. And it's something that relates to that little box that you can see here. Okay, so what does that little box mean? How are we going to use it? What is that for? Well, that little box is what comes here as calls ideal strike zone, and we have the same for puts. Okay, so now because I got a call here, so by default it's highlighted as a call, but I could also get the put box, which is the red box on the left. Okay, so I'll talk about that in just a moment. For now, let me disable everything. This is like a regular, normal risk graph. What I have in here is just a long call. Let me edit that using the expiration date we said we're going to use, which is September 17. Let me go ahead and use the strike which is available, which is the 55. We don't have anything in between. They're all grayed out, so it's 55. So if I click OK, so this is the 55 call, where if you were to trade it now, it has a delta of 67. Okay, that's the delta it has. Again, I'm going to uncheck the call. Okay, so again, you got your delta, your gamma, your theta, your vega, your rho. Remember, we have certain rules. So if you were to build a spread and do it like we normally do, which is you buy one, you sell one. Actually, let me do it like this. Bull call spread. Okay, using September 17, where the one you buy is the 55. And let's say the one you sell is the 65. So you buy the 55 call, you sell the 65 call, and that gives you a net delta of 46. Okay, that's too much based on the things that we normally do, right? We want delta to be around 30. So maybe you go back down here and you buy the 55 and you sell the 60. And now this is giving you a delta of 24.93, which would be the nearest you can get to 30. That's the nearest you can get, because unfortunately, when we look at the option chain with September 17, the strikes available for Siena are 50, 55, 60, 65, 70. There is nothing in between. It's $5 strike price increments. So you can never be that precise when it comes to adjusting your Greeks. So 25, it's the best we could get, right? And this is kind of like something that, even though I'm using a different tool, you guys are very used to in our conversations. Okay. Now, where does the call ideal strike zone comes into place? Well, let me maximize. Let me take a sip of water and let me get into this. Very good. Sorry for that. So, where does it come into place? Okay, so let's start with basic. I'm going to go for a long call, which is what I was doing with September 17 and the 55 strike. Okay, so now if I don't select anything, it says that call got 67 delta, and that's what it provides, and that's it. If I go for a lower strike, it's going to be more delta. If I go for a higher strike, it's going to be less delta. Okay, now what is the meaning of delta? Okay, I mean, delta can be seen in many different ways, but yes, absolutely, Mario. You could also do 60, 65, and you will get a different delta value. And this is exactly what I'm going with what I'm gonna do now, Mario. This is exactly where I'm gonna go. Okay, because in your case, instead of buying the 55 I have here, in your case you are planning to use the 60. Okay, that's what you're planning to do in your case. Okay, which I appreciate. And there are cases where it's gonna be a better solution, but not always. And that's where the ideal strike zone is. Okay, so let me explain where that's coming from. So again, in this case, I'm planning to buy the 55 call. Okay, so let's say that was my trade. So if I'm planning to buy the 55 call, that call has a delta of 67, which means that this particular option, based on options pricing models, okay, which by the way, top runs a binomial pricing model. It doesn't run the same pricing model as Thinkorswim, nor the same pricing model as TOS. It's a more advanced pricing model, which is more precise. It's a binomial pricing model, and it has some enhancements like what I'm about to explain now. So first of all, if you were to be purist and think about delta like it's defined, based on Black-Scholes, if you wish, so delta of 67 represents 67% probability for the option to have some value on expiration. That's what delta means based on this purist definition of delta. So in other words, you have 67% probability of having some value on expiration. Some value. Doesn't mean your trade is going to be profitable, because for you to trade it, you have to pay 488. But at least there is some probability, 67% probability, based on a basic pricing model, that that option will have some value on expiration. Forget about auto climate, forget about AutoUFOs, like let's say you know nothing about nothing. So just based on what's built in the pricing model, that option got 67% probability of having some value on expiration. That's what delta means in this case. Now, this doesn't mean you're going to make money. Making money or not is represented by another probability measurement, which is on the option chain, which is the probability of break-even, which, as you can see, is 36%. Okay, is 36%, which is not exactly 1 minus 0.67, not exactly. Okay, so there is some difference, and the reason why there is a difference in the pricing has a lot to do with the variations built in implied volatility, as well as the fact that you pay for the option. So being in profit, it's more than simply being in the money. You have to be in the money by a certain amount. So let's keep going. So my point is, on the risk profile, if you didn't know anything about options, you didn't know anything about trading, you didn't know anything about trends, you didn't know anything about UFOs. So just looking at the pricing model, that option got some delta, some probability for break-even. And if you go with it, you may say, I'm just going to take this one because delta 67 is a pretty high probability of having at least some value on expiration. And therefore, I may be okay. Okay. Now, let's say you do that. Well, it's somehow a smart thought. But what's the issue? The issue is how the pricing model is made, which pricing models in the world of options trading, they normally represent normal distributions. Apart from all the various tweaks and all the various adaptations to real market conditions and so on, which Black-Scholes model is way too simplistic to represent real markets, even with a binomial pricing model, which is much more complex, you are still assuming a normal distribution. And if I, for the ones of you that are not into math, and I love to simplify, even though I really love science and math, but I love to simplify too. So a normal distribution basically means everything and anything could happen at any time, and some things are more probable than others, but anything could happen, right? That's what the normal distribution means. Well, what's the reality in stock trading or trading? The reality is that not everything is likely going to happen. Not everything is likely going to happen. There are certain things more likely than others. So basically what we've done here with the call ideal strike zone is that we've applied a tweak to the binomial pricing model, where instead of assuming a normal distribution, we are assuming we are applying something called the Chebyshev theorem. For the ones of you that are into math, or even if you're not, if you want to Google it, you can take a look at what it is. It's called the Chebyshev theorem. But basically what this means is that now we are applying stats in a way that is much more pessimistic, where certain things are less likely to happen than others. And then you don't end up with a bell curve. You end up with a shaped curve that represents more of the reality of the trade in a way that is more pessimistic. So in other words, instead of looking at this, going back to September 17 only, instead of looking at the probability of break-even, which is 37%, okay, we are looking, based on a normal distribution, we are looking at the probability of break-even in a way that is more pessimistic, and we are plotting it with a square box, the way it shows, where there are two areas. One area which is kind of like hollow, and one area that is kind of shaded. So the area that is shaded represents a very strong probability for the option to end up breaking even or better on expiration. Yeah, you got it right, my friend. Siderman, you got it right. Chevy Chef. That's how it is spelled. Yeah, very good. So so the darker area, the one that is shaded, represents a place on this risk profile chart where, as long as your P&L on expiration, which is the solid line, not the dotted line, okay? The dotted line, it's the real-time value, which I can emulate and simulate by changing the dates easily here. I'm not talking about the real-time line. I'm talking about expiration, which is the worst case, because what's the worst case for an options trade when you are directional and you buy options? You buy options and the stock doesn't move and the option expires. So then you lost everything you pay for it because it expired. That's the worst case. So the worst case scenario is the line on expiration. And as long as that line on expiration is crossing over the zero line inside the shaded area, that means that this option has a very strong probability to break even or better on expiration, no matter what. Okay, not even looking at auto, climate, UFOs, nothing, just like they're purely based on pessimistic stats. Now, of course, if the option got such a high probability of expiring in the money, it may be very expensive. It may be very expensive. It may have a high delta. Notice in this case, delta is 67. So here is where the lighter area comes into place. So if I edit my spread and I go for a lower option, deeper in the money, okay, higher delta, the probability of ending up with some value and breaking even on expiration is going to be even higher. But now, instead of paying $4.92 for the option, that option is going to cost me $8.85, and on expiration, what's very, very likely going to happen is that you're going to be not only breaking even, but on expiration, which is the darker area, you're going to probably be you will likely end up. Let me bring the values here. So you will probably, let's say you end up in the middle of the zone here on the shaded area here. So the value you would actually make on the expiration date, which is September, is $115. So you would not break even; you would actually profit. But now the price to pay for that is that your cost for the option is double the price, so your risk is double the risk. Okay, so going for an option which is so low will give you more probabilities, but it's too expensive. Going for an option which is 55, it's kind of half the price, and it's kind of like the sweet spot right there in the middle. Okay, what about we go for the 60, which is what Mario suggested? If we go for the 60, unfortunately, this option got low probability. It's outside the box. It's outside the box. So if you're, and in this case, to be honest, because we have, with the expiration date September 17, right? So we have only very few strikes we could select. We only have 55, 60, or 65. We cannot really adjust this that well, even though that's what we have to play with, because the other expiration dates are not liquid enough. Okay? Good research, my friends. Here we go. I got some of you curious about Mr. Chevy Chef, a Russian mathematician. So now, again, just for the sake of demonstration, if I was to look for another expiration date, which is nearer in time, where I may have multiple strikes available. Okay, so notice now I can do, 55, but I can also do 56. So if I do 56, well, 56, it's it's too good. It's too expensive. So what if I do 58? So 58, it's perfect. Okay, but what if I have 58 and a half or 59? So 58 and a half or 59, what if I do 59? It's going to fall in the hollow area, which means that I'm still, pretty okay probable, but the cost of the option now is kind of like optimal, meaning that's the cheaper it gets if you still want to be in the box. Because outside the box above means that option is not likely going to have value or break even or better in expiration. So in other words, if you recall, and thanks for that, Joanne. Thanks for that, Joe, as well. And by the way, I'm giving you an explanation here, trying to be visual. The bottom line is that we're going to filter for this. And when we look for the options, the strategy are going to be built up for us automatically. And they will meet this rule automatically. You will not have to go manually find a strike. It's going to be done for you automatically, okay? But the point of this is very powerful because now, if you recall, with the tools we used to use, okay, which again, TradeStation is amazing. Nothing wrong with TradeStation, okay? And TOS, those platforms are great, but we didn't have certain tools that now we have. So the rule I used to tell you is, okay, so if your target is up here, we said the target was going to be 63 or something like that, right? So if your target is up here, the rule for a bull call spread, for example, okay, what was the rule? Well, if you recall the rule was sell an option, okay, which is above target. Okay, actually, I used to use the word beyond, right? Beyond target, okay, and then we used to say, and buy a call, which is between entry and target. Do you guys remember that? Give me some feedback if that's okay. Do you guys remember those two rules? Now, if you remember those two rules, the question is, when you say between, that's all of this. So where exactly in between? Okay? And in TradeStation, the only tools we had to adjust this the best we could was to look at the delta and look at the gamma and try to find a combination that made it as good as possible. Which, between us, this is not bad. Okay? Of course not. It is not bad. But what are we going to do now? Well, actually now it's going to be buy a call, which is between entry and target, using the ideal strike based on the method I just said, which in this case, it would have been, what was the strike here? Using August 20, it was the 59. So in this case, you would buy the 59, right? And that would be set thanks to this. And now this is the cheapest options with the highest probability it can get out of the cost you pay for it, right? And now on top of that, now we're going to sell options against to build our spread, looking for, our delta we need, our gamma we need, all of those things. But knowing that our base unit, okay, the unit which is key for the profit for this trade, that base unit, okay, is going to be aligned with that ideal strike zone to maximize the probability of ending up with some sort of a profit, at least, even if the stock was to do something which is totally unpredictable and totally not what we expected it to do. At least Mr. Chevy Chef may also help us to end up breaking even or better on the trade if we need to hold it all the way to expiration. Now, bottom line is we are going to be able to build our trades here, and we're going to have a filtering tool here that will be like, show me only the ones that have that rule met and ignore all the other spreads because, here I'm going to be able to build spreads at the speed of the light, all of them with different characteristics. And now I'm going to come in here and basically look at what is it that I like with the rate of returns and the P&Ls. I'm going to show you this right now in a minute. But basically, with the filtering tools, all the spreads that will be built will be meeting that ideal strike zone. So worst case, if the stock didn't behave the way we'd expected it to behave, and we have to hold the trade all the way to expiration, at least we have a higher chance to end up with at least break even or better, okay, and for the lesser cost as possible, based on the availability of strikes, depending on the expirations, the expiration dates that you pick. Okay. How is it going so far, guys? You guys are with me on where I'm going. I will need to re-explain that for sure. I will need to. I'm not even using the last version of top here, so I don't have the filtering that I need to show you. But you guys with me on the process I'm mentioning here. So we're gonna be using the matrix. Okay, see this kind of process using the matrix, where I'm missing also one more tab here to filter by climate. We're gonna be running the shortest list of stock as possible that gives a go ahead, a green light as likely as possible. The moment we get that on the chart with the auto climate, options volume map, AutoUFOs, and all of these, we're gonna have a trade projecting the target with the speed bumps. Now that we have the trade in place, we will decide, do we wait for a retracement, or do we need to take the trade now because we're hedging? And with that, we'll come to a tool such as spread select, where we're gonna be picking the target date, we're going to be picking the expiration date, and automatically all these trades will be built for us. All of this is done automatically by the platform, okay, based on certain parameters that we build. And then what you will do is to simply come in here and look at what happens. And here is the last thing I'm going to show before we go. Just reading your comments, guys. Joe, thank you so much for that. Lots to learn, Leland. I agree. But the implementation, you'll see, is going to be such a piece of cake, even though, of course, we need to spend a few sessions discussing this. Christian, love it. Thank you so much. Jose Chef is awesome. Wayne, you're amazing, my friend. I love your humor. This is so funny. Maka, you have to tell us a story behind creating this at some point. Who are the geniuses behind? I will, Maka. And indeed, there are geniuses behind, and behind my work here, there are more people involved, of course. Thank you, Siderman, for that as well. So now here's the point. Okay, so for example, take a look at this particular trade. Okay, so let's look at this one. Let's look at this one. So, for example, here you have, forget about what we got on the left, okay? So this trade, if you get to the target, it's going to pay you $58. But if you get to the target on expiration, you are only gonna make 50 cents. So in other words, as time passes, you are not being helped, you are being hurt. Compare this trade with the one right above, which if you reach to the target on the target date, the date you expect to reach target based on our projection. But now the trade doesn't work according to plan and you get to the target way later, but now you end up making more than expected. Okay, look at the things now that we can look and check and compare before accepting a trade, which all of this is the effect of delta and gamma working in tandem and all of those things. So now you're going to be able to basically pick from the list the option strategy. Notice how some trades lose all the time. So we're going to be able to filter out all of those and never use them. Look at how some trades, don't do anything special to us, and other trades do have great improvements of performance, like for example this one going from here to here. Okay, so we're going to be able to assess all of this, and basically in the end we're going to filter out. So some of those trades will go out of the list, so we don't need to go crazy up and down looking at the list. We're going to filter out and only look at the trades that matter the most to us, and then execute the trades that are more beneficial. Also filter out based on the risk that each of you could afford, because for example this trade cost $1,597. So you may be like, well, I cannot risk that. Okay, that's too much for me to take the risk. So I rather take another trade with a lesser cost, and we will be able to also input filters that limit the cost of the trade, where you, of course, the less the cost, the less the risk, the less the performance, but at least now you can have the performance and the risk align to your account balance, so you never reach more than what you should. Okay, so we're going to be able to prepare and run all of these different trades automatically, and then just filter out whatever is best for you and look at the different scenarios and just pick, knowing that those trades not only follow our model, our process, our Greeks, our requirements, we also have this added help with understanding performance through time with different what if scenarios. And then when all of this is clear, so then you just right click and take the trade. Again, if you trade with TradeStation, if not, then you would turn around to another platform and execute that trade. You can even chart it here with a risk profile and basically get to evaluate how this trade works and all of it. Okay, but anyway, we are surpassing the time for today's session, so I'm just gonna stop the session here. I apologize if in the past few sessions I am just maybe stepping just a little bit too far, too fast, and driving you or some of you just a bit crazy at times. But no worries. You've seen me do that before, isn't it? That sometimes, I mean, at least that's the way I've seen things work. Learning is a matter of repetition. So sometimes I like to kind of get you stepping out a little bit outside of your comfort zone, and then bring a bit more comfort through future repetitions and repeating the process a few times, and then getting it to practice it together. So this will become muscle memory as we practice this more and more. But hopefully you get to see, how we are adding more tools with two key purposes in mind, which is number one, simplifying and saving time in the planning process, which now I'm not, because I'm explaining the behind the scenes, the why, but later we'll just go do it. So we're going to simplify and save a lot of time in the process. And second, and most importantly, I would say, adding more odds to our trades. Trading is never a guarantee, and we always need to manage risk, and we will for sure. But adding more odds, I guess, is something that we all welcome, isn't it, as traders? And we're going to be able to do that with the use of more advanced technology. Okay. So yeah, I would say this is all for today. Just looking at all the various chat boxes, it seems that everybody's cool. Thank you for that, Ahmed. Thank you, Joanne. You guys are so kind to me all the time. Thank you, Wayne. Would be great to kick the tires with the beta version. It's a bit of logistical problem to do that, Christian. But I think last week I said we are 2 weeks away from the launch. Realistically, we may be 2 weeks away from the launch now. So I'm not sure it's going to be next week. Maybe yes, towards the end. We are very close to launching it, okay? But I just want to make sure that when it's launched, all is smooth, okay? So yeah, and the logistics around beta testing for all of you guys, it's problematic, especially being so close to the launch. Maybe if we did that since, let's say, 3 months back in time, maybe I could have thought about it. But given the fact that we are around the corner from the launch, so I'd like to ask you just a bit more patience, guys, and I'm sure you are eager to have it. But yeah, just bear with me if that's okay. Too much is too better than too little. Get you? Some people say less is more. Some people say more is more. And I think they are both right. Siderman, hear you, my friend. Great weekend, Joanne. Great weekend, everybody. Thank you so much, Mario. Yeah. Yes. Very good, everybody. Thank you for all those comments and chats. See you next week. We almost got a trade ready. But we need to stop the session here. So again, thank you for bearing with me and with your patience with as I am adding new technology, because my main goal always in all sessions is to add more and more trades, because again, no matter the tools and the technology, if we don't practice it, we first of all, we don't make money. Second, we don't develop our skill. So that's my main objective. And obviously in the past few weeks, we had less trades than normal. Okay. So again, bear with me on that. I'm getting there. Thank you so much for your patience one more time. See you soon. Have a good weekend. Thank you so much, guys, for your support and your kind words always. Bye-bye, everyone. Take care.